All right. Happy Friday, Money Mythbusters, episode 5 today. Nate, how are you doing?
Happy Friday. Excited baseball's back, man. Why don't we have
Baseball's back.
another distraction?
Should we just turn this Money Mythbusters into a baseball talk?
Let's
Hockey's
do
back
it.
soon.
Ready.
Hockey's back soon. All right. I'm a Sharks fan here. So that's back August. It's nice to get back to some normality with some sports. All right. So um, get ready to talk about finance, though. That's the most important part. All right. We're going to switch it back over. Myth today. Okay, we're back to talking about real estate a little bit, but more focused on interest rates. So the myth that we're going to be discussing is with rates so low, it always makes sense to refinance, right? And so before we jump into talking about that, always I wanted to make sure that as we're starting out this video, we wanted to talk about the information that we discussed today is from an education purpose only and not from a personal financial advice perspective. Okay, so as Compass Capital, Nathan and I are talking about this. We want to make sure that we're giving you guys just some background information on this and to learn about each of these topics more. I think that's been kind of our focus and our passion is to be able to teach you guys more and more about how to think about these things. And if it's, at some point becomes a need where you need to speak specifically about your situation, this isn't it, right? You guys can visit our website to learn more about how to do that. In addition, we're not going to talk so much about taxes today, but anytime we discuss taxes, it's from a tax kind of education again side and only, okay? Not so much about the specifics or preparation. That's something you should direct to your tax professional. Finally, again, not something from an investment perspective that we'll be discussing around mortgages, but anything that is investment related is not going to be a solicitation to buy. It's never going to be the case on these episodes. All right. Episode 5. Let's talk about it. Rates are crazy low right now, right? I'm talking.
Insane.
I've never seen them so low. Okay, and so I think that's the question we get. They are so low. So every day I get emails about refinancing. Everyone's like, I should refinance, right? Nate, give us the download. Give us what you think about this myth.
Yeah, it's a good one, right? A lot of people say, maybe you bought your house 10 years ago. Rates might have been 4 or 5% back then. Maybe your monthly payment's $2,500, $3,000, and you look at rates and you're like, oh my God, they're at 2.5%. That's crazy. Let's refinance into another 30-year fix. Payments are maybe $1,500 a month now. There's an issue there, right? You might have bought your home 10 years ago, so you've already made 10 years worth of payments. Now we're adding 10 more years of payments if you do another 30-year fix. So even though it might be attractive that the rate is 2.5 instead of 4, and the payment is $1,500 instead of $2,500, you're adding 10 years of payments. So it may not necessarily make sense to do another 30-year fixed refinance, but that's not a requirement. There's a lot of different terms that you could get with a refinance. But I think that's the first thing that we need to bust is just because you have that lower payment or just because you have that lower interest does not mean that it's saving you money over the life of your loan because you already have made 5 years, 10 years, 15 years of payments, and resetting that clock can be more costly over the life of that loan.
Awesome. And so I think that's the perception of when you refinance, right? My monthly payment, right, went down, thus I'm saving money, right? And so we want to tell you that that's not always the case, especially over the life of the loan. You just have to think of it as I extended the loan, right? And now I've got more years to pay. More years means more interest. So you have to evaluate it of what is left, right? Like what you actually have left on your current mortgage versus what this new mortgage looks like, okay? So don't be fooled by the lower payment or lower interest rate. Having said that though, lower payments and lower interest rates, if matched up correctly, will save you money. So let's talk a little bit more about that, right? Like if I'm getting into a refinance, like what are the costs or things that I should be focusing on to help evaluate, am I actually saving money? Like what are the different costs that we have to tie back into doing this?
Yeah. So speaking just quickly to timing, right? If you're 8 years into payments, think about doing a 20-year fix or even a 15-year fix. I actually had a client that had 8 years of payment, so they have 22 years left. The rate difference on a 15-year fix, their monthly payment was actually lower for the new 15-year fix versus continuing with 22 more years of payment. So don't get so stuck on the 30-year fix. Look at the 15-year, the 20-year. If you don't plan on owning your home for that much longer, look at adjustable rate mortgages. You're locking in your interest for 5 years, 7 years, 10 years. Again, if you're going to sell it within that time frame, we're never going to get into an adjustable period anyways. Let's assume that you've made the decision to move forward, right? So let's talk on those costs. Costs can and will be part of your refinance process. Just like when you bought your home, there was closing costs on buying your home. You have to pay the appraisal fee. You have to pay potentially loan origination fees, the credit report. The title insurance has to get paid again, especially if you're going with a brand new bank. The title company, the bank is going to want that title insurance to make sure that they have a clean title. So we're probably looking on average, not talking about prorations for property tax or insurance and resetting your escrow account, just costs related to the refinance, probably talking somewhere in the range of $1,000 to maybe $4,000 cost. But if you're saving on a monthly basis, you do recover that cost with your monthly savings, right? So you need to calculate, what does that recovery period look like? Mm-hmm. If it's something in like the 1 year, 2 years or less time frame, usually it's a pretty good idea to refinance, assuming everything else we said up until this point is also true.
Yeah. And again, those costs, right? A lot of times gets lumped in. If your mortgage, when I say lumped in, it's something that you can wrap into the mortgage itself. Like it, you know, and we'll talk about why you would want to do that. Like if the cost is higher, there's some points that Nate's going to talk about. Like what is a point, right? We're not talking about points in basketball. I'm trying to refer to sports. It's not working. I'm going to cut it out. But you know, I'm just again thinking about, you know, the overall cost, and your mortgage broker or us or whoever it is or yourself can calculate, depending on the interest that you're saving on the mortgage, right, versus the cost, how many months does it take you to break even? And I think that's a really good number to take a look at, because you could say, it's 42 months for me to break even. Am I going to own the home for the next 42 months, right? Like if I'm not going to own the home,
maybe not.
Yeah, if you're not owning it for the next 42 months, then this refinance, again, may not make sense just because the payment and interest rate is lower, right? And so, all right, there's just varying ways to think about this refinance process and making sure at the end of the day, net to you, that you're saving money, right? That's the whole point about refinancing, right? And so there's a topic that comes up about, like, you know, when you're talking to a mortgage advisor or broker, they're saying, well, you can buy down your rate. You can add points to that. So what does that mean, Nate? Like, what does that mean to buy down a mortgage?
Yeah. So in the case where we're talking about points and not lowering your principal, just points, the bank is trying to bank in some profit early on. So they may say, hey, if you pay me 1% of your mortgage balance up front through a point, that's 1.1%. We're going to take you from a 3% rate to a 2.5% rate as an example. And so you're saving 0.5% every single year on your mortgage balance by paying 1% up front. So easy math tells you, you know, it's a 2-year recovery period to pay that 1 point. If you plan on owning this home beyond that, then you're in, you know, bonus round after 2 years. So paying that point is what allows you to buy down your mortgage interest.
Yeah, and it can make sense. Okay, we've done the math, right? It looks kind of crazy to be like, well, 1 point, I'm paying like 5 or 6K or 10K into this.
Right.
But if you actually look at the math, that might be your most attractive option, because again, the mortgage break even, the refinance break even might be that, hey, by doing this, it's really attractive. They're giving me a lot of interest off by paying them up front. And thus I break even in 36 months. And that, again, makes a lot of sense to refinance. Okay. But I think ultimately,
a lot of banks, because of the situation, are also forcing points to be paid, right? We still have, across the U.S., 8% of mortgages are in some level of loan forbearance because of the economic shutdown. And so banks are the ones that are not receiving that principal. It's not that the government is not receiving that money and interest. It's the banks that are taking the brunt of that. And they're saying, well, we'll help you, but we need some profit to be banked in now in order for us to help you. And so we're seeing a lot more of that in the jumbo non-conforming loans. So things of like 650, 700 and above, we're seeing more points being applied and a little less favorable as far as terms or interest rate compared to your conforming loans. And that wasn't the case for the last 3 years. It was actually the opposite, where banks wanted to lend out more of a balance, but banks are just being a little more conservative in today's environment.
Yeah, and again, it's a good point about like just the structure of it when you're going into the refinance process, that the size of your loan is going to vary in terms of, do you have to pay points? Are they building it in? And again, because of COVID, because of these situations, different loan sizes will give you a different experience when going to refinance, right? If your loan's 300K, oh my goodness, the rates are incredibly attractive right now, right? Because it's a lower risk loan for the bank and they're willing to give you a lower rate, okay? But ultimately, it comes down to timing, right? It comes down to timing and your expectation of continued ownership of the home. And so I think that's the point to bring up here in this episode, is that don't just look at rates. Don't just look at payments. Look at how long you've had the loan for. Look at actually what your remaining interest is on the loan. You can go into any mortgage calculator and actually say, here's my remaining balance. Here was my original rate. And here's my remaining years on the loan. Click enter. You actually then see your remaining interest and then talk to your mortgage broker and be like, am I going to be beating this interest over my life of the loan? If not, then why are we refinancing? Okay. And then for someone who's 2 years into the loan and want to refinance because 2018 rates were high. Well, 2 years in, you want to refinance and you want to refinance to a 30-year fix. Again, explore the option. People are offering 29-year loans right now, 28-year loans with a separate rate, okay, of what that looks like. And so if you have I think there's the question out there might be, if I have a 30-year loan, Alfred, can I just pay extra, right? And get myself to pay it off in 28 years? You're right. You will save interest that way and matching up the term again. However, if I can get a 28-year loan or a 25-year loan that actually has a lower interest than the 30-year rate that I'm seeing, I might want to choose that instead because I'm going to be paying more anyways. Why not get the lower rate? Okay. And so it's a mix of those two things, matching expectations of when you're going to own the loan for, timing of the actual loan itself and how long you've had the loan, and then evaluating, okay, what are my costs in doing all of that, right? As long as those all line up, right, then it still makes sense to refinance, okay? I think the end point there is it's not just as simple as payment and interest rate.
Yeah. Something just quick to add, because of the economic conditions going on right now, more and more banks are requiring owner occupancy beyond your refinance. So a lot of banks may require 60 days or 6 months or 12 months of you still living in the home after refinancing. So a lot of people that are thinking about moving because of the current economic situation, wanting to get more space, moving out of the state that they're in or whatever, keep that in mind that your loan may have some owner occupancy requirement. So don't forget that and look for those terms to make sure you're not setting yourself up to have an issue should you decide to move out of your home post refinance.
Awesome. Nice. Episode 5 done. Myth busted, right? Refinance. You should probably, but you need to evaluate much more than just the lower rate and lower payment. Okay. What are we talking about in episode 6? All right. We're going to switch gears a little bit in episode 6, and we're going to talk about next Friday, self-employment and the taxes around self-employment. That's a fun one. That's a really good one. And what we're going to be talking about is the myth of, if I'm self-employed, I should be spending money on business deductions because that's a good way to lower my taxes, right? So we're going to talk about the nuances there. We're going to understand a little bit more about self-employment and really what's the best way in maximizing both deductions and being smart with your dollar in general. Okay. Great, Nate. I think that's it. Awesome. We're going to close this out. Happy Friday, everyone. Watch some baseball, hockey's in August, right? I'm going to start throwing that more into the conversations, especially unfortunately, the Sharks aren't playing anymore. So Sharks fans out there, we're going to be sad for a couple of years here, maybe.
Awesome. Have a good weekend, Alfred.
All right. Have a good one.